Good morning, everyone, and thank you for being here with us for this webinar of Ask the Experts. Like I said, to those of you who just entered the room, but for those of you who maybe didn't hear me or just entered, feel free to submit your questions for Jane either at any point during the webinar using the Q&A feature in Zoom, and we will get to those as soon as we can, or at the conclusion of Jane's presentation. We'll also be on Facebook Live, so if you have any questions, throw them in the comments section and we will get to those as well. Now I'm going to stop talking for the most part. We have a lot of content to cover, so I'm going to just take a quick second and say thanks to STCU for their partnership for Ask the Experts. Thank you for Jane and Rebecca for being here today, and thank you all of you attendees for being here. Like I said, we have Jane Larson. She is the Business Development Officer with STCU with us this morning. Jane has over 20 years of experience helping businesses reach their goals. She is a graduate of Western Washington University, where she studied economics and business. She's a year-round lake dweller, and she loves watching the wildlife change with the seasons and from wakeboarders to wood ducks. So with that, I'm going to turn things over to you guys.
Great. Thank you, Logan. And I thank you so much for allowing us to be a part of this series. We're really excited about it. So I also wanted to introduce Rebecca Dobbs. Rebecca is our Tri-Cities Commercial Banking Manager. She's also going to be monitoring the chat line and the Q&A line, and she has years of experience of working with small, medium, and large size businesses. So she will help answer the question. Between the two of us, we're looking forward to answering your questions. So I'm going to go ahead and share my screen. And we are talking about understanding financial statements today, the basics. So here we go. Now, the one thing that we know about financial statements is that one thing I know about business owners, is that you did not go into business because you love reading financial statements. You went into business because you're passionate about the product or service that you provide, or you wanted to be your own boss, or you want to create wealth for your family, or a whole host or combinations of reasons as to why you're an entrepreneur. But reading financial statements is not typically why you got into business. So I'm going to have a little bit, of challenge here. We are going to move on. I'm so sorry, I lost my page. Bear with me here. There we go. My apologies, technology. So what I know about business owners, as we said, is that you didn't get into business to read financial statements. But what I do know is that there are a lot of business owners who are incredibly skilled at reading their financial statements, and they manage their business based on the information in those financial statements. This presentation is not for them. This presentation is for those of you who might be in the camp where you get all of your paperwork and you give it to the CPA. And the first time you really know what's happening with all of those numbers might be when you get your tax return. Or maybe you're in the camp where you are reviewing your financial statements, but you might be looking at that top line sales and that bottom line profit, and maybe not a whole lot in between. So this presentation is for those of you. My goal is at the end of this presentation, you'll have a few things that you can monitor and look at to understand a little bit more about what you're seeing and some key financial ratios to look at so that you can monitor the health of your business. So let's get started. But before I do, also, just full disclosure, I'm not a CPA. This is not intended to be tax advice or accounting advice. This is simply bankers' view of financial statements, and what I've seen has caused confusion for business owners throughout the years. So we will get started. So as we see our agenda here, we're going to look at the benefits of reviewing your financial statements, 4 beneficial statements to watch, and some key financial indicators. So the benefits of reviewing your financial statements, we already talked about this. It is for you. You want to be able to see what is happening within your company. The sooner you can see changes and monitor changes, the more quickly you can react. If you are waiting till the end of the year, it's too late to make decisions. So you want to monitor these on a regular basis. And what I propose is that by looking at an hour a month, you will be able to identify and track those changes and really see quickly when things are changing. The other reason why you might want to review your financial statements is some point you're probably going to want to get some financing, either from your financial institution or from a vendor. They're going to be asking for your financial statements and they're going to have questions about those financial statements. You want to be able to share the story behind the numbers. When we get financials, we just see the numbers. We will come to you and we will ask. You want to be able to help us understand what's really happening in your business instead of referring us to your bookkeeper or your CPA. Another great reason why you want to review your financial statements is at some point you might want to bring an investor, or more likely, you might want to sell your business. If you go to sell your business, the prospective buyers are probably going to ask for 4 to 5 years worth of financial information. They're going to want to see that the finances are clean, they're strong, that you have strong trends, and that you have strong ratios. You want to show them that because you're going to want to get the best possible price for your business. All right, so we're going to look at 4 financial statements today. We're going to look at income statement, balance sheet, the cash flow statement, and the accounts receivable. I'm anticipating about 45 to 50 minutes. Unless we get some questions, then we might be going a little bit longer. But again, please feel free to ask questions. All right, so this is a traditional income statement. An income statement is also known as a profit and loss statement, a P&L. And this is a traditional statement that you can pull out of QuickBooks. We have income, we have gross profit, we have expenses, and we have net income. Now, this might be a little bit difficult to see, so I'm going to kind of zoom in a little bit. And we're going to talk about some of the things. We've talked about our profit and loss statement. A P&L is always over a period of time. And what you want to see here is at the top of every financial statement is going to tell you what period you're looking at. Here we're looking at a year's worth of information ending in 2019. You also want to look over here and how was this financial statement pulled? Was it pulled on an accrual basis? Was it pulled on a cash basis? A cash basis is simply you are recognizing the revenues and expenses when you get paid or when you pay them. Accrual basis is you're recognizing those revenues and expenses when they actually occur. For example, in our coffee shop, let's say she's a coffee roaster. Let's say she buys beans in September. She pays her roaster to roast them in September. She sells them in September. But maybe she sells it to her customer on an invoice and she doesn't get paid on that account receivable until October. The cash basis, we're going to have all the expenses in September and the revenue in October. It's really wonky to try to understand the true profitability of either period in that case. On an accrual basis, you're going to match those up and see the true profitability. Now, talk about our coffee shop here real quick. This is actually financials are based on a real member of STCU who allowed us to use her financials. We've obviously changed the name and I've kind of evened out the numbers, but we're also going to look at a landscaping company today to kind of compare and contrast. And those are also based on some real numbers. So as we go into and we see this, she looks at just sales. She doesn't break down her sales into hot drinks or cold drinks or baked goods. She just tracks one line item, sales. And then she tracks the cost of goods sold. And the cost of goods sold are simply cost of her beans, her syrups, the baked goods that she sells through her shop. So on sales of $435,000, she has a gross profit of about $250,000. Now let's take a look because income statements are going to vary. Your income statement is going to look different. We saw our coffee shop. Now let's bring in our landscaping company. To our landscaper, he is interested in how is his revenue coming in? What's his revenue from installations, from maintenance, from snow removal? He had a total revenue of about $2 million. He also likes to track cost of goods sold. He wants to know what are the costs of his supplies? What are the dump fees? What are the chemical costs that he's using in his business? So those are the key items that he is looking at. So over $2 million in sales, he had a gross profit of about 1.5. Now we're going to look at our expenses and then we're back to our coffee shop. So remember she had gross profit about 250. She has a whole bunch of different expenses in here. Now these are expenses, or operating expenses that she is going to be paying primarily whether she is selling coffee today or not, right? She has things like payroll. Payroll is her most expensive item at $93,000. little bit of advertising, supplies, repairs. She also has depreciation, and depreciation is simply expensing the use of a fixed asset that is helping you generate profits over time. And I will stop here for just a second. So depreciation, a lot of times, like let's say a piece of equipment, it might have a useful life of 5 to 7 years. If it has that useful life, your accountant can set you up on a depreciation schedule. So you depreciate the expense of it over 5 to 7 years. Now, some of you are very familiar with 179 depreciation, and that is where you might be expensing the entire cost of that piece of equipment this year. I mean, that's great for this year. When you increase your depreciation, you're increasing your expenses, you're going to lower your net income, lowering your tax liability likely. The challenge with 179 depreciation is you're taking all the expenses this year and you don't have those future depreciation to lower and offset income in future years. So just one of the challenges with some 179 depreciation. All right, so now we're going to look at comparing and contrasting our coffee shop to our landscaping company. We saw his gross profit at about $1.5 million. There's a lot of things in here. One of the things we noticed is he has compensation of officers, where our coffee shop did not. Our coffee shop's a sole proprietor. Our landscaping company is an S Corp. He pays himself a wage. He pays himself a salary. She takes draws, and so we don't see her salary located in here. Look at his depreciation, a lot of $318,000 worth of depreciation. He has some interest expense, some payroll, maintenance, truck expense, so on and so forth. We have $257,000 in miscellaneous. This isn't actually all miscellaneous. This is just simply, he had a lot of different expenses and I collapsed them so we could see it all on one page. We also see here that he has some other income and other expense. Now, these are items that aren't usually related to the operations of the company. A big one that we see these days is in other income might be PPP loan proceeds. You might see that down here in the other income category. So, all right, moving on. So we kind of looked at our income statement. Well, now what do we do with it, right? We want to look at some trends. We want to look at sales, gross profit, net profit, and operating expenses. So if we just look at year over year, one of the things we see with our coffee shop here is, wow, she had a pretty nice increase in sales. She is trending up. Gross profit trended up, expenses trended up, net income trended up. One thing about her sales increasing is kind of interesting. When COVID year, she increased about 15%. And the story behind the numbers here is that she's a drive-through coffee shop. She didn't ever have to close down and people were home. They were maybe, a little bit nervous or bored. They had a little extra money they were going through and they were buying themselves a mocha for a little bit of a treat because they weren't really going out to dinner and things. So she saw a pretty significant increase in sales. So we talked about when you're looking at trying to compare period over period, we want to see what contributed to that. An easier way to look at that is by common sizing the income statement. And simply what that means is we're going to divide all of these different categories by the revenue in that period. So we can see as a percentage of sales what each category is contributing as a percentage of sales. So let's take a look at that. So in this case, we divided the cost of goods sold by her revenues, her sales, and we see that she has 43% of revenues, her cost of goods sold is 33% of her sales. We also see that her gross profit, and this is her gross profit margin, is 57%. So we kind of look over year to year, we see that she had a slight uptick in gross profit. And she said this was primarily because she was selling more, she was buying more in bulk, she was realizing some cheaper pricing on her cups. And we can see this kind of going through in her gross profit. Year over year, she's a very stable company. We're not seeing a lot of fluctuations. We see a little bit in payroll. Her payroll as a percentage of sales went down. And this can be attributed really to the fact that she was busier. Her baristas were busier. We can see that. Her net income went up. And this is one of those trends you definitely want to be watching. When you want to watch, is your net income trending up? Is it trending down? Because if it's trending down, One of the things you want to start looking at is, hey, it's harder to increase sales. It's easier to look at where can I potentially cut expenses. So if net income is trending down, you want to look at your expense categories too and see what you can do along those lines. As a side note here, her cost of goods sold on a cash basis for 2021 is going to look a lot worse. I was talking to her, and kind of because of supply shortages, supply chain issues, she's having a hard time finding cups. And so when she finds cups, she is starting to hoard cups. And so her cost of goods sold on a cash basis is going to increase because she's spending a lot more this year to try to make sure she has enough. All right, so let's take a look. Not only are you going to be talking about how do I compare year over year, but how do I compare to my peers, right? So we get this industry data. I pulled this from a source we use, which is called Vertical IQ. And with Vertical IQ, it gives us some peer data information. If you're using QuickBooks, a lot of times there are some reports in QuickBooks where you can look at peer data. If you can't find it or you're not using QuickBooks, always talk to your banker, and also your CPA is a really good source for this information. Vertical IQ, Robert Morris Associates, there's all different kinds of peer data out there. So let's take a look at the peer data, what it says. For one thing, the peer data didn't actually have cost of goods sold for a coffee shop. But they did have some other items like advertising. Most coffee shops, how you read this is most coffee shops spend about 4% of their revenue on advertising. Well, she's in a small town on a very busy street. She's a coffee game in town. She doesn't have to really spend any money on advertising. Let's go payroll. The peers tend to spend 36% as a percentage of sales on payroll, and she's at 21%. Well, I think the story here is that she's an owner operator. She's not paying herself. She's not paying other baristas. She is paying other baristas, but she's working in the business herself, not paying payroll. She's taking draws instead. Rent. Her competitors, her peers are paying 12%. She pays 3%. The story behind the numbers here is that she owns the coffee shop and she owns the land in a separate LLC. She's paying herself rent. She doesn't have to necessarily pay as much rent as somebody else might be doing. So we see total expenses for the peers are about 92%. If we add up her cost of goods sold at 42%, along with her total expenses of 38%, we are looking at about 80%. So she's doing pretty well. All right. So some of the key indicators and trends that we want to look at when we're looking at the expenses is we want to watch operating expenses and we want to compare them to gross profit. So let's take a look and see what I mean here. So when we're looking at gross profit, remember gross profit is your sales minus the cost of goods sold. As sales increase and as gross profit increases, your operating expenses also start to increase. And you get this. Your sales are going up. You might hire another person. You might, if you're landscaping, you might need to buy another truck. You might need to get another skid steer. All different kinds of things start to happen and you start increasing your operating expenses. That's all well and good as long as these two are mirroring. What we don't want to see is your gross profit growing slower than your operating expenses. The other thing is sometimes what happens is this, and this could be all of a sudden your sales go down. Maybe the product that you're selling is stuck on a ship down in California on a container and you don't have it to sell. Or another thing that can happen, and I was just talking to my brother this last weekend. He owns an HVAC company over on the west side of the state. And he was sharing how all of a sudden his supplier told him, come November 1st, the cost of his heat pumps that he installs is going up 18%. He's already bid jobs, and I'm sure many of you in construction felt this too. You've bid jobs, and lumber prices went up. Now all of a sudden, even though your sales may not have decreased, your gross profit sure has, because that cost of goods sold went up. What we have to be careful here is you want to be able to make sure you can start monitoring your expenses and reducing your expenses as quickly as possible, or increasing your price. So it's, you just want to be watching those, making sure those are mirroring at the same pace. Now, in terms of operating expenses, how do you lower them, right? Well, embrace technology as much as you can. If you're in an industry where you're setting appointments and confirming appointments, see if you can leverage some technology to send out those automatic appointment reminders rather than necessarily paying somebody to make those phone calls. You could also look at perhaps some of your workforce is staying home now. When your lease is up for renewal, you might be cutting back on your office space if people are working remotely. You could also potentially look at things like watch your bank statements, watch your credit card statements. You may have been signing up for things that are on a subscription basis. Make sure that things that are being automatically billed to your account and automatically billed to your credit card statement are items that you continue to value. And don't forget to continue to monitor your banking fees too. Your banking needs change over time, banking fees change over time. Make sure you're talking to your banker and making sure that you are using the most efficient services. There's a lot of services that banks give these days to help you automate and become more efficient. Moving money electronically rather than writing checks is a great one that comes to mind. So those are what we're looking at in terms of indicators on the income statement. Now we're going to migrate and go over to our balance sheet. Our balance sheet is simply what you own, assets, liabilities, what you owe. And as you know, the difference between what you own and what you owe is the equity in that, whether it's a house or a business. The balance sheet is just always one day in time, whereas our income statement always showed us a period of time. So let's take a look. A balance sheet must balance. It's in the name. So as we said, the value of what you own versus what you owe on it is the equity. We do a little bit of presto chango, 7th grade algebra, and we end up with assets equals liabilities plus equity. And that is the great accounting equation. And that's what your balance sheet looks like. So let's take a look. We have assets of $49,535. We have liabilities plus equity equals liabilities plus owner equity. That equals your assets. We're in balance. Yay. Super excited. All right. So let's take a little bit closer look at our coffee shop. So our coffee shop, we have current assets and fixed assets. Current assets are simply those assets that you're going to convert to cash or use within the next 12 months. Fixed assets are going to be used for longer than 12 months, like your equipment. Okay. Now we see here, we have the value of the assets, and this is the value that she, for example, purchased her granita machine for $7,500. She has likely depreciated that out. And we see here that bucket of accumulated depreciation. So when we want to look at the value of our net fixed assets, we take our fixed assets minus our accumulated depreciation, we get a bucket value of net fixed assets of $37,635. All right, now we're going to look at our liabilities section. So in liabilities, we have current liabilities. These are due within the next 12 months. Our coffee shop owner doesn't have any long-term liability, so we don't see anything there, but we do see her equity section. So on her equity section, we see her accumulated draws. That's the money she's taken out of the company, $62,250. Her retained earnings are the profits from prior periods that are left in the business. Her net income from this period was $78,000. Her total equity was $37,200. So we see liabilities and equity. All right, so let's take a look and compare and contrast our coffee shop to our landscaping company. So our landscaping company, we see here that he had some accounts payable similar to our coffee shop. He had an overdraft, and this was at 12/31/2019. He also owed a balance on his line of credit. Now he does have long-term liabilities. He had some equipment loans and some vehicle loans. So we see his total liabilities. And now on his equity section, we see that he's actually contributed capital to his company. He's put money, he's invested money into the business. His retained earnings are $19,525, and he has distributed out $248,000. So for him, he had a small loss in 2019, and we see that coming in as a small net loss, so his equity. So let's go ahead and kind of look at we're going to take a different view of the balance sheet. And I present this view because I think it makes it maybe a little bit more intuitive for you than just seeing it linear on the page. Here we have assets equals liabilities plus our equity section. We see our assets are divided into current and fixed. Same with we have current liabilities and our long-term debt. So the important thing to kind of conceptualize here is if we have fixed assets and we want to purchase a piece of equipment, and I really wish I was better at PowerPoint because I really wanted this to kind of like expand and contrast and move these bubbles, but alas, we'll have to use our imagination. So let's say we are buying a skid steer. Our fixed asset bubble here is going to increase. Something has to give to make it balance. Either cash, current assets need to decrease. Maybe they purchased the skid steer with cash, or something on this side has to expand. So the other reason I present this is I'm getting off of financial statements for just a second. Bear with me. I'm kind of getting on my banker soapbox here and going to talk about proper loan structuring. When you're looking at, I need to borrow money, I want you to kind of remember this visualization of a balance sheet. I want your current liabilities to support your current assets. I want long-term debt to support your fixed assets. So for example, if AR is increasing, you're selling more, people aren't selling you, you want to have a line of credit, accounts receivable line of credit behind you to support you with that. So as your current assets increase, you want to be able to increase your current liabilities. Also, as your fixed assets increase, you want to be leaning on some term debt or your equity to increase that. What do we see? A lot of times we see something called misfinancing. And misfinancing is where you might have a current liability supporting or financing a fixed asset. And I know how this happens, and I've been told why this happens from a lot of different business owners. You have this line of credit sitting there, right? And maybe you're not using it and you're in your busy season, you need to pick up a piece of equipment and you say, you know what, I've got that line of credit. I think I'm just going to draw on it. And I don't want to get my financial statements ready. I don't want to get my tax returns and go meet with my banker. Instead, I'll just draw on my line of credit. Right. So now you have financed a fixed asset with a current liability. Well, what's the harm in that? The harm in that is that if you have kind of a shock to the system, like a pandemic or a sudden increase in your cost of goods sold, you want to have this cash available to you. You want to have your line of credit available to you for those short-term cash needs. You don't want to tie it up by financing a fixed asset. So if you've done this, and I know some of you probably have because it's fairly common, talk to your banker, just talk to them, say, hey, you know what? I paid cash for this vehicle or this truck. I think I really should refinance it and make sure I have that cash back in the coffer. So talk to your banker. All right. Now we're going to look at some key indicators and trends to watch. So on our key indicators for our balance sheet, we want to talk about the current ratio, the debt to equity ratio, and EBITDA. All right, current ratio. This is a liquidity ratio, and this is simply your current assets divided by your current liabilities. You want it to be greater than 1. You want more current assets than current liabilities so that you can meet your short-term obligations. So let's take a look at our coffee shop. At the end of 2019, her current ratio was actually under 1. So again, this is why trends are important to monitor how it's going over time. So we also want to look at the industry average. How does she compare to her peers? So her peers have a current ratio of 1.43. And what this means is $1.43 of assets for every dollar of liability. They have a lot of cushion there, and that's what you want. You want to see some cushion. So let's take a look and see what happened in 2020. Remember 2020, she had a big increase in sales. She had a lot more cash. So we have cash, we have current liabilities. Her current ratio went up to $1.88 in current liabilities to every dollar of liabilities. The industry went down as a whole. And this is probably, they may have had to have closed, they might have burned through cash, they may have had to really rely on their lines of credit, so they increased liabilities. There's a whole lot of reasons why the industry went down in terms of their current ratio. All right. Let's take a look at our next trend that I want you to start monitoring over time for your business, and that is the debt to equity ratio. Now, this one is a leverage ratio, and it's calculated simply by adding up your total liabilities, your current and your long-term liabilities, and dividing it by equity. Now, how a business chooses to finance its company, whether through debt or through equity, retained profits, is a business decision. When you have more debt than equity, this ratio is going to be higher. You intuitively know the more debt you have, if you have a shock to the business, you have different debt payments that you need to make. The more highly leveraged you are, a little bit riskier of a position that you're in. So let's take a look at our coffee shop. Now, our coffee shop, remember, she didn't even have any long-term debt. She's very low leveraged. She has a leverage of 0.33. So 33 cents of debt for every dollar worth of equity. The industry is about $1.70. Let's take a look at 2020. She actually has the same ratio. Her numbers changed a little bit, but the ratio stayed the same. The industry went down a little bit. So then the question kind of comes up, can you be too low leveraged? Well, I guess the downside of it, you could be leaving some sales on the table. Maybe you're leaving some profit on the table. Maybe if she took a little bit more debt and she expanded her coffee shop, or maybe she bought another espresso machine so she could get people through sooner or faster. Maybe by taking on some debt, she could potentially increase sales and increase her profitability. So there's a debt ratio in there that is right for you. Now, from a financial industry standpoint, we start getting a little bit nervous when you're at 3 to 1, definitely nervous if you're at 5 to 1. So depending on your industry is going to depend on what's the right debt ratio for you. You might have a loan agreement or a loan covenant that tells you, we don't want you to go any higher into debt than this ratio. So one other thing on here, we'll talk just briefly about it, is remember that 179 depreciation where you kind of depreciated everything out in 1 year? The other challenge with that is when you're depreciating an asset, remember the value of the asset minus what you owe on the asset gives you your equity. And that's part of this here, your equity. When you are depreciating an asset, you're lowering the value of that. You still have the debt there. That is going to kind of change your ratios a bit. So it's another key consideration when you are looking at this. So some leverage ratios, again, for you, tracking it, monitoring it over time is the important piece. All right. So everybody's favorite, EBITDA. EBITDA, it's kind of the buzzword. What is EBITDA? So EBITDA is simply earnings before interest, taxes, depreciation, and amortization. And so this one is really helpful because it kind of takes out the noise of interest expense, the noise of depreciation. As we said, choosing to use debt, choosing to buy equipment, choosing to use 179 depreciation, those are business decisions. That has effect on what the bottom line is that you're showing for that year. If you're trying to compare yourself year over year, you need to look at EBITDA. If you're trying to compare yourself to another company or somebody coming in to buy you and they decide whether they want to buy your coffee shop or the coffee shop down the street, they need to look at EBITDA to try to make a true comparison. So let's take a look at that. Let's look at our landscaping company. Now, we didn't see all of the numbers here with our landscaping company, but what we did see is in 2019, his sales were about $2 million. He had a slight loss of $945. In 2020, his sales went down slightly and his earnings actually went up. So when you look at these net figures, you're like, hey, he had a reduction of sales, 123,000, and yet his earnings went up. He did a really good job of managing with lower sales. Well, that isn't necessarily the whole picture here. We see here in 2019, he had his loss, he had interest expense, he had that big depreciation, and he had some amortization. So we see his earnings based on the operations of the company were 367,000. When we look at 2020, we see that on a reduction of sales of 123,000, he had increased earnings, he had a little bit lower interest expense, He had a lot less depreciation, and he had about the same amount of amortization. So his earnings on operations for his company were about 200,000. So now when we look at this picture, 123,000 reduction in sales, yet his earnings from operations actually went down 167,000. The question is why? Why is that? So the story behind the number here is that it's 2020. He had already had contracts, right? He had already signed contracts for installation, signed contracts for maintenance, and yet 2020 hit and a lot of people weren't working. And he has high quality landscaping. He wanted to keep and retain his crews. He actually increased his payroll by about 200,000 to keep and retain the best possible employees. He didn't necessarily add to payroll, he was just paying his people a lot more. So that's a big change, and that explains the story behind the numbers here. All right, now we're going to move on to our third of 4 financial statements, and these next 2 are going to go a little bit quicker, so no worries about that. If we are looking at our cash flow statement, we are looking at how did money move through this company. This is kind of an interesting statement. This statement marries changes in the balance sheet from one period to the next and includes some income statement items from that very same period. Now, cash flow statements, I want to give a shout out to Ron Nielsen from the Washington State Small Business Development Center. He did the last presentation on business plans, and he spent a good amount of time talking about cash flow statements. And Logan, if we could maybe potentially put a link to his presentation in the chat, that would be fabulous.
I will throw that in right now.
Perfect. Thank you so much. So I highly recommend that you go back and review that, because if you're looking for the cash flow piece specifically, it's about 40 minutes in, but the whole presentation is a great information on writing a business plan, the whys, and how to do it. So back to our cash flow statement. This answers 3 really important questions for us. How did the company get cash for operations? How did it spend cash? And what was that net change in cash? So we're going to take a look here. When we look at the sources and uses of funds, how did it gain funds? How did it spend funds? We look at it in 3 different categories. We see here cash flow from operations. How did this business gain cash or use cash from investing purposes? This is buying and selling of assets. How did it gain cash or use cash from financing? So we want to see all of this. Now, sources and uses of funds, we could spend a lot of time on here, but we won't. Sources of funds are what increased cash. Well, your net income will increase cash. Other things are going to be sources of cash are going to be a decrease in an asset. And you can even think of, if I sell an asset, you're going to gain cash. Or conversely, when you increase a liability, you're retaining your cash or increasing liability, that's also a source of cash. Uses of cash, uses of funds are the opposite. When you increase an asset, you buy something, a decrease of use of cash versus a decrease in liabilities is also a use of cash. You're paying debt down. So it's a mouthful. Thanks for bearing with me on that. So we look at this cash flow statement and we're looking at, okay, so cash from operations, the general operations of this business. Where did they get cash? Where did they use cash? Earnings. They had some depreciation expense. They don't actually write a check for depreciation. It's just a non-cash item. So we add that back in. We have some decrease in accounts receivable. We have an increase in a liability. We have an increase in an inventory. So we see here our sources and uses of cash from operations. We have a net change of 102,000 from operations. What about from our investment activity, buying and selling assets? Looks like they bought some equipment. They used cash, about $60,000 to buy some equipment. And they also got a note. They had a source of cash. So for this business, over this time period, marrying the balance sheet changes with an income statement, they had a year and net change of 92,000. Now, this is important for you as a business owner to kind of monitor and watch, because if you're out of cash, obviously you're out of business. So you want to get this intuitive feel. How did my company do over this last year? How am I generating cash? How am I using cash? All right, the fourth statement we're going to look at is the Accounts Receivable Aging Report. Now, I put this one in here. It might seem a little different. It's not one of the major financial statements that people typically review. But a lot of times I would have people come and sit with me and say, hey, Jane, I've got this accounts receivable. They're not paying me. I'm stressed out. I need to make payroll, or I have to buy some inventory. I've got some payables due. Can I get a loan? Can I do something? It's like, yes, typically you want an account receivable line of credit to support you. And I would say, okay, well, tell me about your AR. Bring in your AR summary aging report. And sometimes you get a blank stare. The summary aging report that you see here is a QuickBooks report that's easy. You can easily pull. It tells you the date that it was pulled on there. And it doesn't say cash or accrual because it's an accounts receivable. It's going to be on an accrual basis. So let's kind of go through this and see what it looks like. This shows you all the different companies that owe you money. It shows you the total amount, what they owe, and down here is your total amount owed to you. So these columns here are how are they paying you? In this particular example, current means you invoice them. Let's say you have 30-day terms. They stay in this current column until they're 1 day past due. When they're 1 day past due, they bump over here. Now they're 1 day past due up to 60 days past due. In general, financial institutions will consider this eligible collateral, eligible receivables for collateral, if you are under 60 days. Okay, so if we were to take that and we say, okay, we have under 60 days here of 213,000. Typical advance rate on a line of credit for AR is about 80%. It could mean that you have about $170,000 of eligible accounts receivable. But as you can tell kind of by where I'm leading with this, it's not truly the case. We are looking also at what is past due, right? If something's past due, we got to kind of wonder, let's take a look at this John George here. He's got $10,000 past due, 90 days past due, greater than 90 days past due. What are the chances of him actually collecting on these other $3,000? It might be at risk of not collecting any of it. Traditionally, banks will eliminate, if there's a certain percentage, 10% past due, 30% past due, typically will eliminate this whole line from being part of your eligible borrowing base. The other thing we take a look at is, look at this one here, your Twin First development. This was a great sale. You're probably super excited about this. You have $135,000 AR due to you. This is what we call a concentration. In this case, we have a large AR that is a big portion of our total AR due. Most financial institutions will eliminate a concentration. They might say 10%, it might be 25%. It depends on the financial institution that you're working with. So when we look at this and we kind of say, okay, well, what does that do to our line of credit for our eligible receivables? When we take these out, including that concentration, now we see our eligible receivables is about 45,000, and we have about 80 at an 80% advance rate. Now we're only looking at about a $36,000 line of credit. Big difference from 170. That's why it's important for you to be monitoring this report, and especially getting on the phone and calling people if they're starting to hit this 31 to 60 days. Make sure you're calling them and having some open communication about getting paid. You want to have some good credit policies and some good procedures to make sure that you are collecting receivables as quickly as you can. So our next slide is actually our final financial slide of the day. We're going to talk real quickly about some turn days. What this one is showing us is if you have accounts receivable of 233,000, let's say your revenue is about 2 million. This is saying right now, based on our revenue, we have about 43 days worth of our sales sitting in our accounts receivable. Now, if your credit policy is 60-day terms, this might not be bad. If your credit policy is 30 days, you might be stretching here. Your customers might be leaning on you to kind of be their bank. And so you got to kind of wonder, wow, if I was collecting it in 30 days instead of in 43 days, what might that look like? Well, I did the math ahead of time, and what this $2 million for over a year is about $5,500 a day. If we were to increase that, if we were to speed that up by 13 days, that is increasing cash flow of about 70,000. That's more cash in your business sooner so that you can make your payroll and you can pay your payables. So it's an important consideration. So if you're finding that your customers aren't paying you as quickly as they potentially could, you could, based on your credit policies and procedures, number one, call them quickly. Number two, maybe you decide, hey, you know what? What if I decide instead to not invoice people and instead I accept credit cards? That would certainly increase your cash flow, but accepting credit cards has a cost too. So you want to kind of do a cost benefit analysis there. If you have plenty of cash flow, by all means, go ahead and invoice the customer. It's not going to necessarily be harmful to you to wait 30, 45 days to get it. If cash flow is an issue, you may want to think about the expense of accepting credit cards. You could also do things like in your credit policies, you could say, pay within 30 days, or there's going to be a late fee, or any number of different considerations that you can do. But like this slide, as with all the other ones, what's important is that you're monitoring and you're seeing changes quickly so that you can react. You want to be watching those trends over time. And so that is kind of the end of our formal presentation today. We talked about reviewing financial statements, the financial statements to look at, and also some key financial indicators to watch. And so I know that with QuickBooks, most of the time you can pull a lot of this information in reports. You can track trends in the performance reports. You can track trends. You can look at how you compare to your peers. If you don't have QuickBooks or you're not comfortable with pulling different reports, one of the things you can do too is create yourself an Excel spreadsheet. Write down key items that are important for you to manage in regards to your business, those key indicators that you want to look at, and look at it over time on a simple Excel spreadsheet. It's a great way to monitor and quickly identify changes. So with that, I am done. I am going to go ahead and turn this back over to actually, let me just put our contact information up here. My apologies. If you have questions, feel free to call me. You can contact Rebecca Dobbs, who's our commercial banking manager. And I also want to say the SBDC, their advisors are fabulous. They are on your side. They are there to be an impartial view for you. Feel free to establish a relationship with an SBDC advisor, and they can help you with a lot of these questions. So
All right.
back to you, Logan.
Thank you so much, Jane. That was, you did a fantastic job. It was a lot of information to cover, and you translated it all into English for us. So thank you for that. While I have you on here at the beginning of this, you mentioned this is not tax advice by any means. But while I have you, can you talk about the relationship the business should have between themselves and their CPA?
Absolutely. Not even just your CPA, but all your advisors. You want to make sure that your advisors are there to help you. They want to help you. So please always feel free to ask questions of your advisors. You want to have an open dialogue with your CPA. You want to have an open dialogue with your banker. Like I said, kind of in the beginning, sometimes people sheepishly came to me and kind of a little bit embarrassed, like, I don't really know how to read this financial statement, right? It's okay. I don't know how to install a heat pump, right? So feel free to talk to us about that information. Also, I want to say something about CPAs. Sometimes I've heard business owners say, I have the best CPA. I don't pay any taxes. They write everything off. That's not really the definition of a good CPA. A good CPA is somebody who is helping you set up your business for long-term success. You want to show profits, especially if you're looking to get some kind of a loan in the next year. You want to have equity in your company. You want to build a strong business, especially if you're looking to sell the company. Writing everything off, that isn't the definition of a great CPA. So look for your CPAs, but ask lots of questions.
that means everything is free when you write it off, right?
Right, exactly. No taxes. So yeah. Rebecca, do you have anything to add to that piece?
Had to find my mute button. No, Jane, you did a great job. Great information. You covered all the points.
Terrific. Thank you.
All right, well, with that, we're going to have information coming out soon on our next month's Ask the Expert session. It's going to be on November 18th, so mark your calendars, and we'll start sending marketing information out on that later today or tomorrow. So as we wrap up, I want to say thank you, Jane and Rebecca, for being here. Like I said, Jane, fantastic job translating all of this into English for us non-finance professionals. And thank you to SDCU for not only being here as our speaker today, but also for being a fantastic program partner. A recording of this session is going to be posted on Facebook Live or on Facebook and on YouTube. And I would also definitely recommend everyone go back and watch Ron Nielsen sessions from earlier this month. So these really do a great job of complementing each other. So with that, I'm going to let everyone go for the day. And thank you all for being here.
Thanks, Logan.
Thank you, Logan.